Hey, Bowtie Nation, thank you for being here. Joseph Hogue here with the Let's Talk Money channel. Thank you for being here for another Beer Money Sunday. Grab your favorite cold one, whether it's an adult beverage or not. I love doing these every Sunday, just kind of having an informal chat with you, taking off the bow tie and talking about money. And this week we've got a great video planned for you. Going to cover my 3 favorite easy options trading strategies, and this is based off of the video we did last Friday, a complete options trading video. And I know it was a long one. It was about 55 minutes, that options trading video, but it covered everything you need to know to put these types of investments in your toolbox. And they're incredibly important tools to be using with investing. It's not gambling. I know a lot of investors have that misconception that options investing is only gambling, and that those high risk, high return types of investments. But it's really a great way to not only protect your money, but to also put on some different kinds of investments that you might not be able to otherwise. So we're going to cover that a little bit real quickly, but please just go back and watch that video. Here I'm going to cover those 3 easy options trading strategies in addition to the 5 strategies that we covered last Friday. So again, thank you for being here. Let me know in the chat if you can hear me, if you can see me all right, and where you're coming from out there in the Bowtie Nation. So I want to get started here, but I first want to send one more call out to sign up for the Daily Bowtie. This is a new daily markets update service that I'm putting out. It's something I've been wanting to do for a very long time now. It's just something to do for you out there in the community, give you kind of a daily market update of the trends, some of the stuff that I'm watching each day. So I put this together and we're launching tonight. Okay, we've been testing it the last couple of weeks, and for those of you out there that's already on the list there, you'd be able to tell the people that haven't signed up yet how much information you're getting in these, because really every day you're going to get market updates on the economy, the stock markets. You're going to be able to see the best and the worst performing sectors and some of the trends in that, some of the best stocks over the last day and why those stocks rose, as well as all the most important news that you need to see before the trading day begins. Those are going out 9 p.m. Eastern every night, every weekday night. So you're gonna have plenty of time to read through that real quick, 5-minute read, easy, be able to understand what your plan is for the next morning for when the stock market opens. So I've left pinned the link there in the chat. Click through that, sign up. It's completely free. Like I said, it's something I've been wanting to do for quite a while for you out there in the nation. Just give you these daily market updates. So it's completely free to sign up. I'll never charge anything for that. But now I do want to get started here because we've got a lot to cover in this episode. We're going to cover those 3 easy option strategies that I'm using for 2021. 3 strategies that you can use even if you've never traded options before, never invested in options before, to protect your money, get a discount on the stock prices. Actually, is one of those options trading strategies, and to do a whole lot more with those. So let's get started. I see a lot of great members of the Bowtie Nation here from Toronto, Vero Beach, California. A lot of people from California. Love it. Got some cousins out there. Happy New Year to you too. They're in the chat. So we're gonna get started here. And we'll have a chance for some Q&A after the discussion point here. But I want to get to those options trading strategies because, like I said, these aren't just ways to gamble in investments. I know a lot of investors think these are purely gambling, ways to take a leveraged return in stocks, and they can do that. You can use the leverage in options to make many times, multiple times what you would make from regular stocks. If a stock goes up 100%, then the options are going to go up 1,000% on some options trades. So you can make those leveraged returns, but the way I use them, the way I like to use them, and the way I suggest a lot of people using them are very much different. These are ways to there are ways to use options that protect your money, that lock in your gains, and ways to cash flow on non-dividend paying stocks. And that's one of the ones that we'll talk about here. So real quick, let's just go over kind of a basic what are options, some of the terminology here, but please go back to last Friday's video and watch that video. I know it's a long one, that 55-minute video, but it is going to give you everything you need to understand these options trading strategies. It's got 5 options trading strategies that we discussed in that video, and it's really going to get you started with everything you need in in options investing to make these a tool in your investing toolbox. So sit back for an hour or two sometime and watch through that video and really be able to understand these. So now basically options are just the right to buy or sell a stock at a specific price in the future. And we're going to go over lots of examples here when we talk about those 3 strategies. So call options, there's 2 types of options. Basically, you can buy a call option, which gives you the right to buy a stock at a certain point at a certain time in the future. Or there's a put option, which gives you the right to sell a stock at a certain point in the future. And these are both for set prices, okay? So you can buy a stock, and let's just go to, let's look at this example right here. Here we've got options on Apple, and these are for January 21st, 2022. Okay, so these are 1 year out, and you can see here that you can buy options for, different weeks, different months. Generally, options trade. You can buy, the near dated weeks ones. So over the next few weeks, they'll have options for those. There'll be usually 1 option available for each month. What I usually like to do is the January ones. Okay, these are called the leap options. So they're long-term options. They usually give you a year out, right? So here we are in January 2021. You can buy options, the right to buy or sell a share of Apple for a specific price 1 year out into the future, right? So here we're looking at these options, and on the left here you see calls, on the right here you see puts. This is just from my E-Trade account. You can buy or sell options from pretty much just about any brokerage platform on the that you're on there. Okay, and so right down the middle here, so you see the options date, right, is January 21st, 2022. That's when these options expire. And understand that options, it's just that. It's the option to buy or sell something on that specific date, right? And then you got this strike price. And this strike price is the price that you're buying or selling that stock for in that future. That's the option price, or the option, what the price you're locking in for that stock, okay? And here you can see, you've got from 122 all the way to 145. You can actually expand this to pretty much any price for Apple, all the way down from, $50 all the way up to $500, right? But you'll notice here where it says last on each side here, this last column, this is the premium, okay? This is the last price that these options were traded. This is what you pay or you collect with these options. Okay, so for example, with calls, it gives you the right to buy a share of Apple for this price, this strike price, on January 21st, 2022. Well, to be able to have that right, you got to pay something, right? The investor that's going to sell you that right to buy their shares away from them at that price, they're not going to do it for free. So they're going to charge you this premium right here, okay? And you can see, obviously, if with Apple trading at 132, when I took this screenshot, with Apple trading at 132, if you want to be able to buy it for 122 in a year from now, you're going to have to pay a pretty big premium. The investor that's going to sell you this option, this call option, wants to charge you $24.50 to be able to buy that option. Okay, so you pay the $24.50. And then a year from now, you can buy Apple, no matter where it's at, you can buy Apple for $122.50. Now, obviously, for these more expensive strike prices here, to be able to buy Apple for $145 1 year into the future, you only have to pay $14.50, okay? Because, this is out of the money right now. Apple shares are actually below that point. So, you're buying the right to buy it at a price higher than it is right now, but you get it into the future. You get it 1 year from now. So they're not going to charge you that much for that right. So it's just the basics of options, right? And the thing is, when you buy these options or sell them, we'll talk about selling options as well. These option prices are going to change throughout the year. Okay, these options prices are going to, the premium on those prices are going to go up or down depending on where the shares of Apple go. Okay, if Apple shoots up to 145, then obviously anybody selling that right to for somebody to buy those call options, they're going to charge more than $14.50. Okay, and anytime during that year, you can sell these options back. If you bought this call option to buy Apple for $145, if you bought that for $14.50, and shares of Apple shoot up to 150, 160 bucks, then you can sell that option to somebody for much more than $14.50. So really, just because just because you buy it for a specific date in the future doesn't mean you can't buy or sell these things all the way to that point. Okay. I see some really good questions here. How is the premium priced? The premium is really priced on a lot of things that we really don't want to get into just yet right now. It's very complicated. Basically, the premium is just where the stock price is trading right now in relation to that strike price and how much time is left. Okay, plus kind of the volatility in the stock. Okay, so if we were to look at some of these other call options for Apple, if we were to look at the one, here maybe April 16th, 2021, obviously very much sooner than January 21st, 2022. So much less time for that option to become more valuable, right? So those would be cheaper to buy those than to buy the longer dated ones. So time is one way these options are priced. Okay. Obviously in relation to the stock price. So if Apple was trading at 150 right now, those calls to buy it at 145 would be much more expensive. Okay, because the stock price would already be above that strike price. So that's two. And the third one really is volatility. Okay, if Apple just has a tendency to move up or down 10% in a day, then obviously anyone selling these options wants more money for these options, right? Because the possibility or the probability that these option prices go up or down is going to be much higher if this is a much more volatile stock. Okay, so for example, and we'll look at some Tesla options as well. But Tesla options are much more expensive than Apple options, right? Because Tesla just happens to move much higher or lower in when it trades. Okay, it's much more a volatile stock. Okay, that's also why if you look at buying options or selling options on ETFs, so funds. So if you own, say, the SPY, which is the Spider S&P 500 index fund, tracks the S&P 500 index. If you were to buy options on that, they're much cheaper actually because it's all those stocks together and they kind of even out the stock price moves, right? So that's really how options are priced there. Okay, I just wanted to cover a few reasons why you might want to use options, and then we'll get to those three strategies here. Okay, and one of them is really something that a lot of people don't think about it, and this is why options are becoming so popular this year, with some of the shares of your favorite stocks, Amazon in particular, becoming so expensive. So let's bring up the Amazon options chart here. Okay, so here's Amazon, and you can see to buy a share of Amazon, you would need $1,306, right? Is this? No, this is actually the call. Okay, that's the option. Okay, I'm sorry. To buy a share of Amazon, you would need $3,280. Okay, a lot of you heard me say you could buy a share of Amazon for $1,300, and you went to your broker because that's a pretty damn good discount, right? No, shares of Amazon are $3,280 right now, which is out of reach for a lot of people. Okay, $3,000 for just one share of stock, you wouldn't be able to buy anything else. And especially to buy 100 shares, right? To buy 100 shares of Amazon, that would be $328,000. Okay, and one thing you got to understand about options is that they're priced in lots of 100. Okay, so you buy one options contract, and that represents 100 shares of stock, right? So if you were to try to do that with Amazon to just buy the stock, you'd need 328 grand to buy that. But you can go into Amazon options. You can go to this call option, which is the January 2021, right? So it expires here in about 2 weeks. So you probably wouldn't buy this one because it expires soon. But you could go into this January 21 call option for $2,000. So basically, you're buying the right to buy Amazon for $2,000 a share, right? And right now it's priced at $1,306. Which is obviously much lower than than that $3,200 per share of Amazon, right? And let's just look at what this option has done over the past year, right? So basically, the start of 2020, you're looking at Amazon shares, and actually, let's see what Amazon was doing at 1 year ago. So 1 year ago, Amazon share prices was trading at $1,869. Okay, so 1 year ago, you're sitting there, you want to buy Amazon shares because you think this is the next big thing, right? And it's $1,800. You can't afford that. Who can afford 100 shares of Amazon at $1,800, right? It's $180,000. But you could have gone to this call option and said, okay, you know what? I want to buy the right for the next year to buy Amazon for $2,000 a share, because I think it's going to go way beyond this $1,800 a share price it is right now. And at that time, shares of Amazon, the Amazon call, were trading at about $156. Okay, so $156, much more manageable for most people. 156 times 100. So you put down $15,000. Right, you put down $15,000. That gives you the right. That's one call option, one call contract. Gives you the right to buy 100 shares of Amazon for $2,000 in January 15th, 2021. Okay, and look at what it did. You bought that for $157 each. That call option, and now here we are. It's worth $1,320. Okay, so basically now, technically, the call option gives you the right to buy Amazon for $2,000 a share. When that call option expires here in about 2 weeks, in January 15th, you could actually buy from the investor that sold you those call options. You could buy that Amazon shares of Amazon stock for $2,000. Put down $200,000 for the 100 shares, and it would be yours, right? Or like I was saying, you can buy and sell these options anytime during that. Right. So basically what you're going to do is, if you don't have $200,000 to invest in Amazon, even still, for those $2,000 per share, you just sell these call options that are valued at, $1,360, right? So you sell that $136,000. Okay. You paid $15,600 for 100 call options, right? Or call options for 100 shares. You get $136,000. That's a 9-fold return. Okay, so not only did buying these call options allow you to, to invest in Amazon at a much lower price, invest just $157 a share for that exposure to Amazon, but it also allowed you to, to make a much higher profit than what shares have done. Okay, Amazon at about 3,200. It's pretty much doubled since, since you bought those call options. So a leveraged return, but also a way to buy shares of stock that you couldn't have otherwise, just buying the shares. Okay, so that's the first reason why you might use call options, right? And that's the second reason, is really that leveraged return, right? A lot of people like to be able to get that 10 or 20-fold return on their money on the stock price itself. Okay, so another reason a lot of people don't realize, though, and it's a great way to lower your risk. We talked about covered call options and protective puts in Friday's video, and we're going to kind of go over the covered call option today as well. But a lot of these, because you can sell someone else the right to buy these stocks from you, they're paying you that premium. So it's a way to collect money on your investments that can, one, if you're doing it at the same time you're buying, it can lower your cost of the options, or cost of the stock, right? It lowers your price in the stock. Or two, it just gives you a kind of a hedge, right? If you say the tables were reversed here, and you own those shares of Amazon. 1 year ago, you owned those shares of Amazon at $1,800, right? But you're worried that Amazon has just run so far, so fast, and you want to take a little bit of risk off the table. So you're going to sell somebody the option to buy these off you for $2,000. And remember, trading at $1,800, those options that option was already, or was still out of the money, right? Somebody's saying, hey, I want to buy these to you from $2,000, but it's only worth $1,800 right now. Okay, so they're going to give you $157, just to hold those shares and maybe sell it to them for $2,000 in the future. While you collect that $150, right? and that takes some risk off the table, right? If shares of Amazon fell 150 bucks or so or whatever, 200 bucks, say they fell about 10%, so it fell about 200 bucks, you wouldn't be out that money, right? Because you collected that $150 for those call options, so it would have hedged your risk a little bit, right? And finally, another reason why you might want to use call options or options in general is just to get stocks at a lower price, and that's another one we're going to highlight in these, in these investments. So we're going to get started on those 3 options investing strategies, right? These 3 trading strategies. One is going to be to get a leveraged return on shares of, we'll use Tesla as an example. Another one is to cash flow on non-dividend paying stocks. Love this one. This is one that I use quite a bit. And a third one is going to be an options trading strategy to get a discount on shares of stocks that you want to buy anyway. So we're going to cover those three options trading strategies. Please, though, watch the Friday's video. Make some time for it because it is going to take you through step by step in each one of these. I know options can be very confusing. I had to read a book that was about that thick for the CFA exams. They can be very confusing. But if you spend just a little bit of time, watch that video. It's 55 minutes long. It will give you the tools that you need to be able to use these for anything you want to do in stocks. So again, great video. Make sure you watch that. But let's get started in these. And the first we're going to do is called a bull spread, and we're going to use shares of Tesla as an example. Okay, I did see just a value time account. Oh, okay. So Randy sent through a super chat of $5. I appreciate that, Randy. Just wanted to see if you had a question there and go ahead and answer that. Just to make sure that the super chat didn't come off of the screen. Nancy, thank you again. Another super chat there, $5. I appreciate that. If you do have a super chat, then be sure to ask a question if you have that, and I'll try to get to those. But let's get to these. This bull spread is for Tesla, right? And a bull spread is when you buy call options, and a lot of times these call options. So you see here. Shares of Tesla right now are, what are they, about $718, right? Just over $700. So to buy call options on Tesla, which would give you the right to buy shares of Tesla at any of these prices in the next year, right? January 21st, 2022 again. There's the strike price. So if I wanted the right to buy Tesla at $700 a share, okay, in 1 year from now. But the problem is Tesla is just so damn volatile. It goes up so much. Sometimes it goes down so much that the options are very expensive, right? $200. I would have to pay $200 for to buy the right to shares of Tesla for $700. Okay, and that alone would mean my cost basis was going to be about $900, right? If I paid $200 to buy the right to buy Tesla for $700 a share, that's $700 plus the strike price or plus the premium of $200. It's a $900, right? Now, I get to do that, in a year from now. And if Tesla does anything like it did over the last year, it's up like 2 or 3 fold, right? If Tesla goes up even doubles to, let's say, 1,500, and I have the right to buy it for 700. That's a pretty darn good return. I only had to pay $200. So there next January, if it doubles, those call options are going to be worth, $800 each, right? So 800 divided by 200, that's a four times return on my money. Okay, so it's a pretty darn good return, but it's a pretty big risk. We're paying $200 right now on the hope, on the idea that Tesla is going to go higher. Still $200, and again, for each call option or each contract you buy, that's worth 100 shares, right? So to buy that would be, that'd be $20,000, okay? And most people just don't have the 20 grand to plop down for that one call option for Tesla. So now what you can do though is what's called a bull spread, okay? And this is a way to cut your costs of buying that position. It's also a way to kind of hedge the risk a little bit in this. So what we would do here is, for example, if you bought this $201 premium for shares of Tesla at $700, you could simultaneously, let's say sell the 850s. Okay, so this last strike here, the $850, that's for somebody that wants to buy Tesla for $850 in the year, and you can see that's quite a bit cheaper, $153, right? they're going to charge you $200 for the right to buy Tesla for $700 in a year from now. But if you only want to buy it if you want to pay $850 for it, you only have to pay $153. Okay, so so you can see that kind of that difference there. Now, what I can do is I can buy the 200s, right, or I can buy the 700 calls for 200 and sell someone else the 850s, okay, and collect 153 from them. Okay, so my net cost is only $48. Now, what this does is in a year from now, I've got a call option to buy Tesla for 700. I can exercise that and buy Tesla shares of 700. Now, if it's over 850, someone else has the call option on me to buy my shares for $850, right? So I've got that $150 difference there where I'm making money, and I only had to pay $50 for that, right? That $48. Now, so the potential here is to make $150 each here on these on this difference. I only paid $50. The potential is $150 max between that 700 and the 850 strike. So that's a 212% return, or $10,000 profit on an investment if the shares go beyond that $850, right? So you get that leveraged return, plus it costs less than those straight calls, okay? And again, you know, I mean, I know this can be confusing at first glance, first time you hear it. That's the bull spread, the spread options are something that we covered in Friday's video. But just a great way, and a way I love to use to really get into a call option for less than it might be, especially on some of these very volatile stocks like Tesla. But you know, you still get that exposure and you get that leveraged exposure. Okay, so so look into that. It's a bull spread. You can also buy a put spread if you think maybe shares of Tesla are a little expensive right now. If you think that the stock could go down, but you know, again, for example here, if you want to buy a put, which is the right to sell Tesla for a specific price, if you want to buy a put on that, it's going to cost you $183, right? If you want to sell Tesla for $700 in the future, maybe you want to lock in the price for the shares that you own. You want to lock those in at 700 at minimum. You're going to have to pay $183 for that, okay? But if you also, you know, simultaneously sell someone else the put of maybe 670 here, you'd collect $170 back, right? So really that spread, you'd only be paying you know, $13, right? So look into those spreads. It's a great strategy to get into some of these call options for a lower price and get some leveraged return there. The next one I want to cover here is called the covered call strategy, and this is probably the majority of what I do in my options trading, right? Covered call strategy, and there's two ways you can use these, right? Now, a covered call is just you own the stock, right? So say I own shares of Tesla, and you know, Tesla doesn't pay a dividend, but I'm a dividend investor at heart, so I will always want to get paid while I'm investing. You know, so what I can do is I can sell those call options to somebody. You know, right, again, so that's the right. Somebody wants to buy the right to buy my shares off me for a specific price at a specific time in the future, right? Here we're talking, you know, January of next year. Well, they're going to pay me that call premium. They're going to pay me to be able to have that right. So, you know, that's just a way that I can collect some money on that stock that doesn't pay a dividend and basically cash flow on that stock, right? Another way that works out is, like we said, it just kind of lowers your risk in that stock. If I'm collecting $200 on my shares of Tesla, then that's really lowered my risk, lowered my exposure in the shares by that amount. Okay, and the example I want to use here is going to be an old-time dividend payer that has fallen deeply out of favor. Look at this: shares of General Electric, right? General Electric, GE. Used to pay great dividend. Used to pay, 2, 3, 4% dividend at times. Used to be a solid dividend, and then they cut it in 2018, and now it's just a penny, a penny dividend per share each quarter, which is basically nothing. So if I still own shares of GE, I believe in the future. I think they're going to rebound. But again, I'm a dividend investor, and I want to collect some cash while I'm investing in these. Then I can go into these GE call options, right? I can go into these options, and again, this is for January of next year, is when these options expire, and I can sell these $15 strike prices. Okay, so this is down here, $15, and that's the right for somebody to buy my GE stock from me at $15 by January of next year. Okay, and right now they're going to pay me 85 cents to do that. Okay, so I'm going to collect 85 cents per share for every share of GE that I sell, in these call options, right? I still keep the shares. I'm just selling someone else the right to buy those for $15 in the future. That is an 8% yield on the current price, right? And the best part about this is the shares would have to rise by 39% for that investor to buy those shares from me, right? They bought the right to buy those from me at $15. Okay, well, it's only $10.81 a share right now, so they're not going to do it unless the share price goes up. If the share price goes up 39% to $15, they're going to exercise that option, buy those shares for me at that price. So I lose my shares, I get $15 for them, but I also keep that 85 cents a share, right? So I have essentially made this a dividend stock for 8 cents, 8% yield for that year. Plus, I get that 39% return if they call that option from me. Got a super chat here for $5 from NC. Thank you for that. He says, might be a stupid question about spreads, but how am I able to sell a call or a put if I never have owed a put or call on that stock? No, see, I mean, call options are completely different investments. Options are, you don't have to own the stock to buy a put or a call. You can just go out. I could buy call options on Tesla right now. I don't own shares of Tesla. I don't plan on owning them right now, but I could buy a put or a call. Now I could also you could also sell a put or a call. It's just a separate investment. Okay, you don't have to own the call options to sell the call options. Okay, basically it's just going to be an unsecured option. Okay, so if you sell a call option to somebody, that gives them the right to buy the shares from you at that price in the future. And you collect that premium, you collect that money. Now, you don't own that stock. So if they, in a year from now or whenever that option expires, if they come to you and say, hey, I got this call option, I want to buy the shares for that price in the call option, then you would have to go into the market and buy those shares at whatever price they are in the market and sell it to them for that strike price. Okay, so there is a risk if you're selling those options. If you're buying the options, then the options investment is worth just whatever that premium is worth. You can never lose any more than what you paid for that premium. If you sell the options, if you sell the call options or you sell the put options, then there is more of a risk because you have the obligation to either sell the shares to them in the example of a call or buy the shares from them in the example of a put. Okay, so there is that risk, and a lot of trading platforms, a lot of brokers, they're going to make you have a margin account for that. Okay, right? So if you have that higher risk, if you buy or sell a put that gives you the obligation to buy the stock away from somebody because the put gives them the right to sell their shares to you, then you have to have the money in your account to be able to satisfy that put option. So it's a great question. Legitimate question, but yeah, these are separate investments from the stocks, and you can use them as that. Okay, so again, to our covered call example with GE here, I've just made GE a dividend paying stock, 8% yield. I get to keep the shares, and if the shares rise by 39% over the next year, this options investor, this call buyer, is going to buy my shares for $15. So, he's going to buy my shares away. I get that 39% return because the shares went up to $15, and I keep his 85 cents. So I keep that 8% yield on the shares. So another great way to use options investing there, the covered call strategy. And again, another one that we highlighted in Friday's video. So make sure you look for that. Now understand there are risks to these. Okay, for example, with the covered call strategy. So you gave somebody the right, or you sold them the right to buy those shares from you for a certain price. Now, if GE surprises us all and goes to $30 a share, not going to happen because it's been pretty tough luck lately. But let's say, for sake of argument, GE goes to $30 a share. I already sold somebody the right to buy them from me for $15. Okay, so I still get that 39% return because they went to $15, but I don't get anything beyond that. Okay, so there is a risk that if those shares take off, I'm tough luck. I'm out of luck on the extra return that those shares would have made. I always keep that premium though. I always keep that options premium. So that 8% plus the 39% that I returned, with the stocks going up to 15. That's the downside to that particular strategy. And there's a risk and there is a downside to all these strategies. So make sure you understand what those are. One more options trading strategy I want to get to, and then we'll get to your questions there. And this one's going to be a great strategy for actually getting stocks that you want to buy for a discount. Okay, and I love this strategy. I love to use this strategy because it works really well with that buy and hold long-term strategy where you're just buying stocks and holding them forever. But with this strategy, you're going to get them at a discount, which is always great, right? So let's look at call options for Apple. Okay, so here we are on the options for Apple, and again, you can see we've got calls and puts here. Calls here on the left, puts. These are for January of 2022, with Apple trading at about $132, right? So now, if I'm looking at Apple, I'm like, okay, they've got. Apple owns everything. They're about to get into an electronic vehicles, they say, in the next few years, and I want to be part of that. I want to be shares of Apple. But they have gone so far this year. How high has Apple gone this year? What, 50, 60% or something? It's just ridiculous to look at the valuation sometimes. So I'd feel a little bit better if the shares were around maybe $120 each. 120 would be 10%, right? I would like to pay 10% less for shares of Apple. Well, what I can do here is I can sell those January 2022 puts, okay, let's just look at the $155, right? So I go down here, and again, remember, the put option gives you the right to sell shares of a stock to somebody else for that price. Well, that's the buyer. If I'm selling that, then I have the obligation to buy those shares for that price from that person, right? So if I sell the put options, the $155 put or 155 strike put options for Apple, and I know this can be confusing the first time you hear it, so just bear with me here. Okay, these 155. These puts give somebody the right to sell Apple for $155 in January of next year. If I sell that to them, then I'm buying shares of Apple for $155. Seems like a kind of a shitty deal, right? If Apple is selling for $132 right now, why am I going to be buying it for $155? Well, because right over here you see the premium they're paying. They're paying $33 for that right. Okay, that's going to be insurance for them. Maybe they own Apple shares and they're scared it's going to go down, so they're willing to pay $33 for insurance. That no matter how far Apple goes down, they can sell them to me for $155, right? So basically, I'm going to say, yeah, I'll buy your shares of Apple for $155 in January of next year if you pay me $33 right now. That gives me, so basically, okay, if, let's say for the sake of argument, Apple does stay under $155, right? Whether it falls from here or stays the same, it's under $155 in a year from now. They sell their shares to me for that price. Well, since I collected that $133, my real cost of Apple is now $121, $122, right? Because I paid them $155 for their shares, but previously they had paid me $33 just for those options, right? So right now I can lock in my price for Apple at $122, about an 8% discount to the current price. And I wanted to buy the shares anyway. So I wanted to buy the shares anyway because I love the future for Apple. I think it's, I think it could go higher, but I wanted that discount. So 8% discount on shares of Apple. Now the outcomes here. So again, if Apple shares stay below $155 by next year, somebody is going to, that investor is going to sell those shares to me, and I got them for $122 each. Okay, so that 8% discount. Now the downside here, it's kind of an upside, kind of a downside, whatever you want to look at it. If Apple shares rise above $155, then they're not going to sell those shares to me for $155. Okay, let's say Apple goes to $185 by the end of end of this year, into January of next year. If Apple's trading for $185 and they want to get rid of their shares, they're just going to sell them in the market for $185. Right? They're not going to use this contract and sell it to me for a price that's less than the market. Okay, so I'm not going to be buying the shares from them, but I still get to keep that $33 that they paid me. Okay, so that's pretty much a cashless return. Now on this strategy, then if you do agree, and like I said, a lot of brokers, a lot of platforms, they're going to make you have money down in your account just in case you do have to buy these shares from this person, right? So, if I agreed to buy Apple for $155 per share, then for 100 shares, that's $15,500, right? So if I have that 15.5 sitting in my account, ready to buy these shares in January of next year, but I collected that $33 per share, so basically $3,300 I collect from that person selling me those put option or buying those put options from me. That's a 21% return. Okay, so your two outcomes here for using this protective put or this cash secured put option is, one, you get the shares for a discount. You wanted to buy them anyway, you get a discount here. So I mean, that's kind of a win-win for you. Two, you had this money sitting in your account waiting to buy those shares for that year. The shares went over that price, and you kept the premium for an instant discount or an instant return, right? So you either get the shares for a discount of what you wanted to pay for them, or you get that 21% return. You get that instant return on your money. So again, just another great options trading strategy that I like to use. One of my favorites for that long-term buy and hold kind of idea. If I see a stock, very rarely do I just go and buy a stock in the market. If nothing else, I'll go and sell the puts maybe a month or two out. Okay. Usually for this kind of strategy, I don't go all the way out to the 1 year puts. So I wouldn't right now go out to this January 2022 puts because I wouldn't want to wait that long to get the shares. But I could go out to maybe a March contract. I could go out to maybe these March options for Apple, sell the puts to somebody, collect, don't collect that 8% discount, but maybe you still collect a 5% discount to the shares, right? So I would get a 5% discount, get the shares in March, and be able to hold them for as long as I want after that. So just another great option strategy. Be sure to watch watch that Friday options video though, because that's 5 options trading strategies. It's going to cover the basics and beyond for a lot of these that we talked about, and really be able to make sure that you use these to really make money like you can. So now we're going to open this up to questions and answers, and I want to I want to scroll back up here and see if I missed any questions. If I didn't see your question, just make sure you put it there in the in the chat below. Make sure you use a question mark so I can see that. And I'll get to that. Last day, do you need a connection? Okay, thanks for the options video. Neo call options. I'm not going to be covering specific options on specific stocks because that would mean we would have to go in